Hi everyone, Stacy Whiter here on behalf of Campus Mortgage with part 2 of a 3-part video series on comparing mortgage insurance on Fannie Mae loans. Now just a quick reminder before we get started, this video is for informational purposes only and should not be considered legal advice or used in place of Fannie Mae guidelines. Also, this video was issued on October 16th, 2018, and the information contained in this video is subject to change without notice. So in part 1, we talked about the monthly premium option for mortgage insurance, and we looked at an MGIC example. In this video, we're going to take a look at the single premium options, and then in the next video, we'll take a look at split premium. Again, reminder, this is for conventional loans, these examples, and not government loans. So single premium, as another option, has no monthly mortgage insurance premiums. Instead, it's similar to FHA's upfront mortgage insurance premium, where they pay a one-time upfront MI premium at closing. It's paid by the borrower, or it can be paid by the lender or the seller. And obviously, if the seller is paying it, it cannot exceed the contribution max limits. It can be paid at closing or financed into the loan amount. And if the lender buys the mortgage insurance, they typically are going to increase the note rate or discount points to indirectly cover the cost of the MI premium. And the entire premium must be paid at closing. Also, the MI coverage rate is based on the LTV and the MI provider. So the max LTV is 97%. It can be purchase, construction, or limited cash out transaction, but it does have to be a one-unit primary or secondary home. This cannot be done on investment properties. And there is a potential tax deduction if you have this type of MI. Again, this is not tax advice. Make sure you see a tax professional. And some benefits are that it may have lower PITI compared to monthly MI. So because the borrower is paying that one-time upfront fee, their monthly payment is going to be lower because they're not spreading the cost out over 30 years of payments. Also, the financing, higher loan amount, so a downside would be that they're financing a higher amount if the premium is financed. And there's potentially higher closing costs. Obviously, the borrower would need to bring more money to closing if they're not financing it in to pay that upfront premium. Now, again, typically the lender is going to choose the MI provider, so depending what MI company they go with, but it's going to be based on the lender. So let's take a look at an example of what this would cost the borrower using that $250,000 loan amount. So let's take a look at that now. So we're going to use the same loan amount of $250,000. We're going to use the same LTV. Let's use the same credit score of 720. Our property state is Georgia. We're going to have the same debt to income of 45%. To borrowers, primary residence, fixed rate, detached, everything the same here. But what we're going to do is we're going to change the premium type from monthly to single. And again, our coverage is going to stay the same here because of our LTV. Now let's go ahead and submit that and see what we come back with. So wow, that's a pretty significant amount. So in this example, the borrower would not have a monthly MI rate, but the single premium of $6,375 would need to be paid at closing. Now it can be financed of course, financed into the loan amount as long as it meets all of the requirements. But again, you would want to weigh this with the option versus the monthly versus the single premium. But again, this can be paid by the lender, the seller, or the borrower, but would need to be collected at closing. All right, that concludes part 2 of this 3-part video series. Make sure you check out part 3 where we talk about the split premium and compare the rates. Thanks so much for watching. For more tips and videos, please visit campusmortgage.org to look for their weekly mortgage video tips designed for all mortgage professionals, including underwriters, loan officers, processors, closers, and post-closers. Have a great day. We'll see you next time.